Section 3, Money and the Monetary System. Unit 1, Money, Money, Money. Unit 2, the Fed. Unit 3, Other Hands in the Money Game. Here's a quick exercise. Pull out your wallet or purse, and take out a dollar bill, or a 5 or 10 if you're feeling flush. Feel the bill in your hand. Look at it carefully. See the face on the bill? Whether it's Washington, Lincoln, or Hamilton, why is that photo there? Why is the bill with the photo of President Lincoln on it worth 5 times the one with President Washington? Is it merely the words $5 and $1 that make it so? And who says this flimsy piece of paper with oddly tinted green ink has any value at all? In the same ways that letters represent sounds and words are merely symbols of ideas, money is representative. But of what? How much do we really know about this tool we use for bartering our way into a double tall non-fat latte? Imagine you are on a desert island far from civilization. You've been collecting seashells all day and there's no drinkable water in sight. You happen to pass a woman sitting in the sand, on a straw mat. She is surrounded by coconuts she's collected, and she looks up as you approach her. You would really like a coconut. You can just taste the coconut water and know how refreshing and delicious it will be. You offer her several seashells for a coconut. She looks at your shells, but is not interested. But then she notices your prized shell, a rare piece of abalone that you were excited to find. She indicates that she'd like that shell. You hesitate. You're so thirsty, but you're not sure you'll ever be able to find another piece of abalone like this again. Finally, your thirst wins out, and you strike a deal. 2 coconuts for your abalone shell. A few moments later, as you tip a coconut back and soothe your parched throat, a man comes by. He indicates he wants your other coconut. You remember how thirsty you were before, and you're not anxious to make a trade. What if you don't find another coconut before you're thirsty again? The man has a straw basket. He offers it to you. You realize that, lined with leaves, this might be a good way for you to collect water from a stream. You strike the deal. Try going to the bank to deposit a straw basket, a coconut, or an abalone shell. The teller would look at you as if you were out of your mind. And how do you make change from a coconut? Measuring money. How much money is there? Did you ever stop to wonder? The amount of money in circulation is important. When consumers have money, they often spend it on goods. That money finds its way to manufacturers, which use the money to pay employees. Those employees spend their money on goods. That money finds its way to manufacturers. See the cycle? If there's less money in circulation, less spending happens, which slows the economy. So, back to our original question, how much money is there? It's not as simple as everyone adding up their bank accounts and the money in their wallets. Let's learn more. The measures for money are tied to a specific concept. What is it? Liquidity. Financial analysts classify money as M1, M2, and M3. Liquidity, which is the ease with which an asset is converted to cash, differentiates these categories. The U.S. Mint and the Bureau of Engraving and Printing. You'd probably get into a lot of trouble if you tried making your own money. That privilege is reserved for the U.S. Mint and the Bureau of Engraving and Printing. But go ahead, try it. We'll bring you cake and letters from home, we promise. Which one does what? The U.S. Mint and the Bureau of Engraving and Printing are both into money, among other things. Which agency does what? Remember, coin is done by minting, paper is by engraving and printing. Produces paper currency. Bureau of Engraving and Printing. Produces coin currency. U.S. Mint. Produces U.S. passports. Bureau of Engraving and Printing. Produces metals. U.S. Mint. Sells and stores platinum, gold, and silver coins. U.S. Mint. Produces immigration and naturalization certificates. Bureau of Engraving and Printing. Unit 2, the Fed. Lesson 1, the Federal Reserve System. Lesson 2, Federal Reserve's Functions, Reserve Requirements. Lesson 3, Federal Reserve's Functions, Rates. Lesson 4, Federal Reserve's Functions, Open Market Operations. Lesson 5, Federal Reserve's Response to the 2007 Financial Crisis. Lesson 6, the Fed's Role in the Truth in Lending Act and Regulation Z. The purpose of the Federal Reserve System. Established in 1913 by the Federal Reserve Act, the Federal Reserve System, aka the Fed, is commonly referred to as the nation's money manager and the U.S. central bank. However, it's actually comprised of 12 regional banks and multiple member banks. The Fed was initially charged with the supervision over bank activities and facilitation of the selling or discounting of commercial paper, loans issued by commercial banks for personal property purchases by consumers or short-term needs of businesses. The Fed was designed to influence the supply of money and the cost to borrow money toward a three-part goal of maximum employment, stable prices, and moderate long-term interest rates. Long-term, the Fed seeks to provide consumers with a rising standard of living, which involves increased consumption. Short-term, the Fed seeks to avoid extreme inflationary periods, during which the prices of goods and services increase, or deflationary periods, during which the prices of goods and services decrease. In other words, the Fed seeks to ensure that the economy grows at a balanced pace, but not too fast. Today, the Fed also regulates depository institutions, banks, credit unions, etc. The Federal Reserve is organized into districts, with Federal Reserve branch cities and member banks located across the country. Federal Reserve Districts. The Federal Reserve is made up of 12 districts that serve all states, as well as U.S. Commonwealths and territories. Each district is represented by a bank city that serves as that district's head office. These banks interact directly with member banks and the U.S. Treasury. Federal Reserve Branch Cities. There are 24 branch cities located across the country that support the activities of the district banks. Cincinnati, Ohio. Pittsburgh, Pennsylvania. Baltimore, Maryland. Charlotte, North Carolina. Birmingham, Alabama. Jacksonville, Florida. Miami, Florida. Nashville, Tennessee. New Orleans, Louisiana. Detroit, Michigan. Little Rock, Arkansas. Louisville, Kentucky. Memphis, Tennessee. Helena, Montana. Denver, Colorado. Oklahoma City, Oklahoma. Omaha, Nebraska. El Paso, Texas. San Antonio, Texas. Houston, Texas. Los Angeles, California. Portland, Oregon. Salt Lake City, Utah. Renton, Washington. Member banks. More than 1/3 of the banks in the country are Federal Reserve member banks. All national banks must be members of the Federal Reserve System. Many state-chartered banks are also members, and must meet certain criteria. Member bank requirements. Purchase stock in their district reserve bank equivalent to a specific percentage of their capital, in order to maintain sufficient reserves. Obey Federal Reserve rules and regulations. Benefits of membership. Access to Federal Reserve financial and information services. Borrow money from the district bank, when needed. Stability of performing activities under the Federal Reserve's protection. Federal Reserve Organization operates independent of all government agencies. Members from all different areas within the Federal Reserve System work together to form the Federal Open Market Committee. Board of Governors, known as Federal Reserve Board, consists of 7 members, all appointed by President and confirmed by the Senate. These members serve one 14-year term. Members may be appointed as a chair or vice chair of the board. The board influences monetary policy, analyzes financial and economic conditions, and supervises the financial services industry, among other responsibilities. Federal Reserve Banks. Each of the 12 Federal Reserve Banks has a member board of directors. The banks are responsible to this board, which oversees the bank's activities and management. Federal Open Market Committee. FOMC enacts monetary policy with a goal of stable prices and economic growth. FOMC consists of 12 members, 7 Board of Governors members, President of the Federal Reserve Bank of New York, 4 presidents from the other Federal Reserve banks, which serve on a rotating basis. Reserve requirements. Amounts that member banks keep on deposit with their district Federal Reserve Bank are called reserve requirements. They help ensure that banks will have funds available when they need them. The amount a member bank must keep on reserve can vary anywhere between 3 and 22%, depending on factors such as the location of the bank and the type of deposit. City banks tend to have higher reserve requirements than rural banks due to their higher activity level. Checking accounts have a higher reserve requirement than savings accounts because checking deposits are considered more short-term than savings deposits. A consumer makes a deposit at their local bank, a Federal Reserve member bank. The member bank accepts the deposit. The member bank uses a portion of the deposit to make loans. The member bank deposits a specific percentage of its funds with its Federal Reserve District Bank. Changing reserve requirements. The Federal Reserve can influence the money supply, and thus the economy, by changing the amount member banks are required to deposit in reserves. When the Fed increases the percentage member banks must keep on reserve. Member banks must keep more funds on reserve at their district bank. Member banks have less money to use as loans to the community. The local economy slows down because less money is available. When the Fed decreases the percentage that member banks must keep on reserve, member banks keep fewer funds on reserve at their district bank. Member banks have more money to use as loans to the community. The local economy heats up because more money is available.